So, Derek, volatile week certainly in the markets, culminating with Friday not being a very fun day. Lots of red across the screens. Talk about a number of things that are happening there, really, but the tug of war between inflation, rising interest rates, and can the economy continue to grow? Clearly, that was in the highlight this past week.
Right. We had a pretty good week going until Thursday, at which point Jerome Powell sat down with Christine Lagarde from the IMF, and they talked about inflation and the issues the central banks are having with its increase in recent months. And essentially, he put 50 basis points on the table. And while I feel like I sometimes get too close to the markets in the sense that we're constantly hearing headlines and comments, the market took that very negatively, and now in some places is pricing in roughly 150 to 200 basis points of Fed tightening moves in the next 6 months, which is a little bit higher than what people had thought, which basically resulted in the sell-off.
Yeah, that'd be an aggressive move for sure. And of course, we saw the bond market react to that as well. So you saw 10-year Treasury yields spike this past week. You see the anxiety that causes among investors as we try to figure out, what's the proper multiples we should be paying for stocks. And also been a big driver behind some of the rotation that we've seen away from some of those high growth types of areas that really led the market last year. And people starting to look more closely at dividend growth, dividend paying stocks, shift the portfolio to a little bit more of a value orientation. All of that really just being driven, like I said, I call it a tug of war. It's that element of, will the Fed be too aggressive, push rates too high? Is that going to cause a recession? It's recessions that we worry about as investors.
Right. And right now, our base case is that we will avoid a recession. I mean, I saw a data point this week which blew my mind, and that was that households have more cash on their balance sheet than they have debt, which is the first time that's happened in 30 years. So you would think that barring some major increase in unemployment and a decrease in consumer confidence, the U.S. economy ought to continue to do okay in the face of higher rates. And in many ways, the market itself is already tightened for the Fed. This week, the 2-year note was trading at 2.75, which basically is pricing in 11 Fed rate hikes. So, at some point, I think the market's going to digest this, get accustomed to it. And right now, the expectation on our part is that we're going to see a 50 basis point rate hike in May and some moderation in the CPI and PPI in the months going forward.
And you're already starting to see some of the effects of that in terms of decreased demand. And that's really what the Fed tries to accomplish by pushing up the federal funds rate. Over time, what we're trying to do is reduce demand. And one of the places you're seeing it is in the housing market. So fewer homes are going to be sold into the future because people are digesting what it means to have a higher interest rate on their mortgage. And, you're going to get to that spot where staying in the existing house with a much lower mortgage rate becomes more attractive than buying a newer house or upgrading and paying a higher interest rate.
The housing market has a lot of impacts, not just the sale of the home, but also the purchase of appliances, yard work, and so on and so forth. And the housing market, the problem there is there's just not enough inventory. And yes, housing affordability has declined. So despite the fact that there are less homes, prices have tended to hold up, even though demand has waned somewhat given the higher construction costs and higher prices there. So again, the U.S. economy is doing okay. Growth is slowing. We know that. Inflation, as I mentioned, the comparisons going forward get much more difficult. In fact, half the increase of inflation over the last 12 months came from cars, both new and used. So if you think about that, as supply chain bottlenecks resolve themselves in the car industry, semiconductor availability improves, you could see some moderation of these supply constraints. So in some ways, the Fed is trying to push a thread through a needle, right? I mean, at the one hand, they want to curb demand, but at the other hand, supply ought to start to rebound from some of these COVID-induced supply chain constraints we've lived with for the past several years.
In like 20 years, we've seen a low inflationary environment, and to a large extent, that's been because of globalization. We've been the benefactors of being able to import lower cost goods and services from around the world. And what we're starting to see right now is, maybe people are rethinking that in terms of, we talk about supply chain disruption, for example. And certainly as we look at used cars and new cars and people talking about chips as an example. So it'll be interesting to see how that stuff plays out.